Someone whose job it is to write about financial markets investing, I've got to admit to a deep-seated distaste for the word systematic. It sounds wonky, it reads wonky, just sounds kind of robotic. Well, at least that's what I thought for a long time. But over the years, as I've started to read and hear more about the pioneer in factor-based investing, Dimensional Fund Advisors, I must admit that I'm gaining a grudging respect for the word systematic. We're fortunate today to have with us Wes Crill, Dimensional's head of investment strategists. Wes, please help us wash some of the wonkiness off this word. And can you kind of explain what does systematic really mean for investors?
Yeah, of course. One really helpful analogy for it is systematic is too active what using a map is versus trying to just make up where you're going while you're driving somewhere. The idea behind the genesis behind systematic investing was that it's something that was rules-based, it was repeatable. And so it's sort of like once I have a map that tells me where to go, I have directions to get to someplace, I'm no longer relying on just making a call that in some ways is trying to predict what's going to happen in the future. And so I think of that as one of the defining traits there. Of course, that also suggests within that analogy that there was further opportunity to improve upon the systematic approach. And that was really using something kind of like GPS, where it uses updated information, where it is continuously evolving in terms of the information it was providing. But again, I just come back to this notion that it was a way to cut down on some of the noise associated with making predictions about the future in markets.
Sure. And again, for our readers and listeners who aren't aware already, DFA's process is very rules-based and very systematic in terms of not covering wide swaths of the markets.
Yeah, exactly. We think of it as taking the most appealing aspects of traditional index fund investing, the broad diversification, low cost, repeatability, like we were just speaking about, one of the benefits of systematic investing in general. But then we use a daily process that has flexibility, and that allows us to react to changes in information. It's security prices aren't going to wait in between periodic rebalancing events before they absorb news and changes in information about the future. And so we want to have a process in place where we can reflect changes in information as they become known to market participants and update our portfolios accordingly.
And that's real important when you compare your funds to like index funds, traditional index funds that just track the Russell index or the S&P or something like that, correct?
Absolutely. And there's a couple of different ways it's advantageous. One of them is expected returns. If you're targeting higher expected return securities, well, security price plays a huge role in that. So when prices fall for certain securities, then you want to have the opportunity to add those or increase your weight in those securities. But it also serves as a really important risk control. So when I think back to the meme stock craze in early 2021, and you had the price of GameStop surging through the roof. Well, GameStop went from being a small cap stock, which was held in many of Dimensional's small cap portfolios, and almost overnight, in the span of a very few short days, it became a very large stock, one of the largest in the U.S. market. And so having the flexibility to then sell that security from our small cap portfolios in short order helped keep the focus of those small cap portfolios on the securities that really were meant to be in there.
Sure. And also, can you talk a little bit about your process on the back end in terms of systematically trading out of positions and trading into positions?
Yeah, absolutely. I mean, you want to have flexibility anytime you're interacting with financial markets. If you come to markets and you demand immediacy, let's say you want to effect a trade in one particular security on a particular day, that's demanding a service of market participants. And market participants are like any other professional where they do not work for free, and they will charge you for demanding immediacy from them. And this is where, when you marry the flexibility of our process with the broad diversification, we don't have to trade in any given security on any given day. We might have multiple candidates that are equally desirable for steering the portfolio where we want it to go. And we will look for ones in which we can get the best execution price, the ones that have the most available liquidity in markets, so that we can trade at more advantageous prices.
And again, you're not trading all the time. It's you have pretty low turnover funds, correct?
Yeah, we have similar levels of turnover to an index fund. The difference is we spread that turnover throughout the year. It's akin to preparing for a dental visit by brushing your teeth a few minutes every day rather than 3 hours a day before you go for your checkup.
And again, the traditional index funds, such as Russell and S&P, they get into some front running type of problems and those sort of things, correct?
It certainly can happen, right? If the whole market knows what you're going to do and when you're going to do it, then they might attempt to get ahead of you and take advantage of you. And in the case of the Russell indices, if you think about the delineation between Russell 1000, the large cap indices, versus Russell 2000, that's very rules based. It's formulaic, and it lends itself to predictability. So market participants can get ahead of, okay, these securities are going to be going into the index. These securities are going to be deleted from the index. And I know that index fund managers are going to be trading accordingly. So you can see that the impact on prices for new additions to those indices, it starts to run up prior to the actual effective date for the index change. And we think that's evidence of market participants taking advantage of an area where there's not flexibility for the index fund managers. And that's precisely, or one of the many reasons why we want to have flexibility in our process.
Sure. And have you done much research in terms of how much this can help investors in terms of returns?
So it's a very challenging value to try and back out or put a number on for a number of reasons. You get a couple of different things going on. Number one, you have securities that are going into an index. That means they're going out of another index. And so they might have competing effects in terms of selling in one index fund and buying in another. Some of it just depends on, what else is going on with the security. Have there been any corporate actions preceding that addition or deletion? All of this is meant to show a lot of caveats around the idea that we look into what the value add is of not trading when the index fund trades. And I think the important thing to keep in mind is it's not zero. We believe it is an expected value add no matter what. Certainly can vary through time, but it's just one of the many things we often talk about, trying to capture every basis point, because when you capture basis points along lots of different dimensions for your portfolios, they can add up to a great investor experience.
Okay. Thank you very much for your time, Wes.
Thanks for having me.